We backtested the asset growth anomaly on U.S. stocks for 25 years. Low asset growth companies returned 12.78% compound annual growth rate versus 7.85% for the S&P 500. That's nearly 5% annual excess with a Sharpe ratio of 0.697 and shallower drawdowns than the index. Companies that resist the urge to build empires tend to outperform. Here's what the data shows. The universe is all U.S. stocks on NYSE, NASDAQ, and AMEX above $500 million market cap with at least 2 years of annual balance sheet data. We compute annual total asset growth using the most recent fiscal year versus the prior year. Total assets include everything: cash, receivables, inventory, property, plant and equipment, goodwill, intangibles. Some researchers use only operating assets, but we use total assets for simplicity and reproducibility, consistent with Cooper, Gulen, and Schill's original 2008 study. 3 profitability filters remove distressed companies that show low asset growth because they're failing, not because they're disciplined. Return on equity above 8%, return on assets above 5%, operating margin above 10%. Without these filters, the portfolio would include companies shrinking because their business is dying, not because management is disciplined. These 3 gates together ensure every company in our portfolio is genuinely profitable. The bottom 30 stocks by asset growth form the portfolio, equal weight, rebalanced annually in July. Why July? Companies with December fiscal year-ends have until late March or April to file annual reports. July gives every company ample time, and the 45-day lag from fiscal period end ensures we only use publicly available data. No look-ahead bias. Transaction costs. Use a size-tiered model. 0.1% for mega caps, 0.3% for large caps, and 0.5% for mid caps. Annual rebalancing keeps turnover low, typically 40 to 60% per year, so trading costs don't eat the premium. Cooper, Gulen, and Schill found a 20% annual spread between low and high asset growth deciles from 1968 to 2003. That's the raw, equal-weighted, no-transaction cost number. With quality filters and a large cap universe, the implementable premium shrinks considerably. Watanabe et al. Found the international spread was 6 to 8% per year, still economically significant but far from 20%. Our realistic expectation going in was 3 to 6% annual excess return. The anomaly has a rational and a behavioral explanation. Ho, Shui, and Zhang argued that firms invest when expected returns are low, so high investment mechanically predicts low future returns. The behavioral story is simpler. Companies that grow assets aggressively, especially through acquisitions, tend to overpay and destroy value. Lipson, Mortal, and Schill found the effect is driven primarily by growth in non-cash assets, particularly property, plant, equipment, and goodwill. Cash accumulation alone doesn't predict underperformance. That distinction matters. A company hoarding cash isn't the same as one loading up on goodwill from a bad merger. Here are the U.S. numbers from 2000 to 2025. $10,000 invested in 2000 grew to $202,100 versus $66,200 for the S&P 500. 3 times the ending wealth from the same starting point. The Sortino ratio is the standout metric here, 2.038 versus 0.628. It measures return per unit of downside volatility only, and the strategy's variance skews heavily upward. The bad years aren't nearly as bad as the good years are good. The dot-com crash was the clearest demonstration of this strategy's edge. In 2000, while over-investing tech companies burned through cash and inflated their balance sheets with goodwill, low asset growth stocks beat SPY by over 34 percentage points. In 2001, the excess was 28 points. Capital-disciplined companies held their value while empire builders collapsed around them. If you've been holding this portfolio through the dot-com bust, your account would have barely noticed a recession was happening. The 2008 financial crisis told a similar story. The strategy posted 12.8% excess return that year. Banks with bloated balance sheets got hit hardest. Companies that had grown assets modestly through the mid-2000s didn't carry the same toxic exposure. The maximum drawdown for our portfolio was 28.3%, nearly 10 points shallower than SPY's 38% drawdown. That's the difference between uncomfortable and catastrophic. Then came the rebounds. In 2016, The strategy outperformed by 15.5%. In 2020, by 9.6%. These weren't crisis years. They were the early stages of recovery where the market rewarded quality and discipline over speculation. The worst periods were 2018 and 2022 through 2023, when growth and mega-cap stocks dominated everything. Low asset growth stocks lagged by 10 to 12% each year. In a market where the biggest companies grew assets aggressively and their stocks doubled, owning capital-disciplined companies felt painful. But that's the trade-off. The quality filters reduce the raw academic spread and improve consistency and risk. We're not capturing the full 20% decile spread from Cooper's paper. We're capturing a more investable version with better risk-adjusted returns. The anomaly works best during and after market corrections, when companies that overinvested during the boom get punished hardest. Disciplined operators hold up better. The 2001 to 2003 period was the best stretch in our backtest. The market fell hard and companies with conservative balance sheets barely felt it. The 2008 to 2009 period showed the same pattern, with the added benefit that our quality filters kept us out of the financial stocks that imploded. Even in average years, the anomaly produces a modest positive spread. This isn't purely a crisis play. It works because the underlying mechanism, overinvestment destroying returns, happens in every market environment. Some companies always overreach. The anomaly captures that tendency regardless of whether the broader market is up or down. It struggles during momentum-driven bull markets. In periods like 2013 to 2015 or 2020 to 2021, the market rewarded aggressive growth and speculation. Companies investing heavily in AI, electric vehicles, or other hot themes saw their stocks surge despite rapid asset growth. If everyone around you is making money on high-growth names, a portfolio of boring, disciplined companies tests your conviction. The anomaly has held up unusually well post-publication compared to other factors. Many academic anomalies weaken or disappear once published, as traders exploit them away. From Cooper's 2008 paper through 2024, the basic signal continued producing a positive spread, though smaller than the original 20%. One theory: low asset growth stocks tend to be boring, mature businesses. Institutional investors face pressure to own growth stories, not stagnant companies. That behavioral bias against boring stocks keeps the premium alive. The denominator problem is real. Small companies with $100 million in assets that add $50 million show 50% growth. Large companies with $500 billion that add $50 billion show 10%. Percentage-based calculations penalize small company volatility. Some researchers use log asset growth to reduce this effect. Goodwill from acquisitions can be impaired years later, causing sudden drops in total assets that look like discipline but are actually prior mistakes showing up late. A company that overpaid for an acquisition in 2018 might write down goodwill in 2022, showing low asset growth that year. Our quality filters catch some of these, since impaired goodwill often comes with declining return on equity and margins. But not all. The productive investment problem is the biggest caveat. Amazon, Alphabet, and Microsoft all had high asset growth for years and all outperformed massively. The anomaly works on average, but the exceptions include some of the best performing stocks of the last 2 decades. A pure low asset growth strategy would have missed all of them. Combining low asset growth with high profitability produces the strongest version of this signal. And pairing it with momentum captures companies where the market is starting to recognize discipline. That is what the data shows across 25 years. Full results, charts, and a backtest code are on the blog at cetaresearch.com. Link in the description. The asset growth anomaly is one of the most robust signals in academic finance. The code is open source at github.com/cetaresearch/backtests. Subscribe so you don't miss the next backtested strategy.